Tim Guinness is Chairman and Chief Investment Officer of Guinness Asset Management. He manages the global energy fund worth $393 million. Tim, good to have you in the studio again. And we just had the International Energy Agency actually publish their latest report, and they're revising their forecasts in light of, well, tough economic situations and how that's going to impact demand. Does this come as any surprise to you?
No. No. Of course, I've only had about an hour to read the IEA report. But they've trimmed their forecast for world demand. I think it's just in line with everyone's expectation. The absolutely key factor in determining what the oil price will be over the next 12 to 24 months is going to be the behavior of Saudi Arabia in particular, and of course their fellow Middle Eastern states, Kuwait, and the UAE, who have boosted production to make way or to deal with the Libya shortfall. They've now got to reduce it to let Libya come back online.
And perhaps somewhat unsurprisingly, speaking to Mr. Abdullah al-Badri, he hinted that this wouldn't necessarily have to be the case, and as I said, you may expect him to do that, but his argument was that Libyan oil has its own distinctive, they have their own customers. Of course, we all know that it's a different quality of crude compared to that which Saudi Arabia has been pumping to make up for the shortfall. But if that's the case, then it begs the question, well, why did some OPEC countries bother boosting production in the first place?
Well, they had to boost production because there was a shortfall. It wasn't quite what the customers wanted, but the customers wanted something. I think that's the short point.
Do you think it necessarily follows, though, that as Libya comes back online, that Saudi Arabia will necessarily make any alterations to its production? Will it just continue as before?
No, I'm absolutely certain that they will take somewhere between 750,000 and 1 million barrels off the market, which is roughly what they boosted their production.
So they will take that off the market. And then what about the upcoming OPEC meeting? Do you think that they will come to any sort of decision? Will they make more progress than the last one?
OPEC is a funny organisation. I think it's a brave man who will predict how they'll behave, but or what they will say. But I think you can predict now. We had 12 years of really quite effective OPEC behaviour. Roll back to sort of 1998 when they had to deal with the last significant period of oil weakness. They have always cut to put a floor under the price.
Yes, and I suppose one thing that Libya really showed was the importance of having the spare capacity there if and when you need it, and particularly given the trouble that we've seen in the Middle East, it is conceivable that we could see more instability, more protest next year. So with that in mind, prices need to stay elevated enough for them to invest in that sort of thing. Do you think that will be the case?
Yes. But you've just triggered a little bell I want to react to. More trouble in the Middle East. I think we've got to be very aware that the situation in Syria is very serious. And there's a sort of powder keg there right next door to Saudi Arabia.
Do you think many people are thinking about Saudi Arabia and the implications of problems there?
I really hope not.
No.
No, we're not thinking about it, but in the back of our mind, we know that if Syria becomes significantly destabilized, that could bring Iran in some fashion on the opposite side to Saudi Arabia.
Well, there you go. You've just opened up a whole host of new issues to talk about. Why is this a good bet? What's your view on the company?
We like Statoil. They are the world's best deep water operator. They are sort of a national champion for Norway. They've got a very interesting province to the north of the Barents Sea. They've got a problem in the Norwegian continental shelf that now is quite mature. But they're doing the right thing, we think, to deal with that. You've got the Barents to the north, and then they've got the Gulf of Mexico. They're building up assets in Brazil, onshore North America, a bit of Africa. So we like all that. And then we can buy this stock on somewhere between 6.5 and 9 times earnings. Really, you can pick an oil price for next year and a gas price, and you can't with earnings, but it's very, very cheap.
All right, so it's cheap for the moment, but CEO himself saying that, look, oil prices could go even lower before the year's end. Is this something to be concerned about, perhaps not just for Statoil, but other companies too?
No. We know what the oil price is going to... Well, we are sure the oil price is going to set back from what's been a spike caused by Libya. It's going to average $80 next year. That's a pretty good price. That's back to the 2010 price. 2011 will be seen as a bit of a spike. You combine, and these companies are not valued at $80 oil. They're valued as if the oil price was somewhere between 60 and 70.
But are they also going to have to start, you said that Statoil had basically matured in terms of findings in Norway, but then are they going to have to start looking beyond their own doorstep? For example, one of the things that Helge Lund was speaking about was Arctic exploration, but of course that also requires a great deal of technological expertise. There are risks there.
Yeah, but they've got it. They're the best company in the world at this sort of thing. By the way, important thing has happened in the last 18 months. The frontier between Norway and Russia that runs in the Arctic north of them has now been agreed.
Yes.
And that really helps their ability to actually do some work up there.
Something else to bear in mind. Thanks very much indeed. Tim Guinness, Chairman and CEO of Guinness Asset Management.